Hello. Welcome to the Financial Literacy and the Engineer webinar from the IMechE. Your panelists are Ismail Erturk of Manchester Alliance Business School, Christopher Simpson of Simpson Associates and the IMechE's Management Group, and myself, Paul Ballington of Rolls-Royce and the IMechE Management Group. A little bit of a different format today. We're going to do a short presentation, and the real meat of this is for you to be able to ask questions about what's meant by financial literacy and what key thinkers in this, like Ismail Erturk, think are the key things that will help you be a successful engineer. Little about me. My interest in finance began when I was working for Firth Brown in the 1980s. Here I saw the essential role of the markets in long-term supply agreements, and in fact we had a London Metal Exchange company, and the source and cost of funding on the feasibility and forms of contracts and major investments. The exposure to London Metal Exchange particularly showed me how you actually could protect your profits from commodity market shifts. And then during project finance, where we're involved with government financing, I also had exposure to major capital projects, and these showed how our businesses' credit rating and cost of money were almost more important than the technology decisions they were taking. So what is finance? Well, simply, it's nearly as misunderstood as engineering, but you can think of it as having two main camps. The first camp is the management of money. And within that camp, naturally, we have three main camps itself. And this is the area that most people think about when they think about finance. The first of those is financial accounting and reporting, outward reporting to external stakeholders, and compliance with accounting standards. Then we have the internal accounting within a company, which is known as management accounting. And this looks at the control, monitoring, and internal application of financial resources. Finally, and more applicable to large companies, there is the management of money flows within a business, its various divisions around the world, and its banks. And here you get into functions such as treasury, capital forecasting, and budgeting. The second area of this is acquiring the funds needed by a business. And this covers the relationships that we have with banks, the borrowings that a company has, important decisions of debt versus equity. People think that selling shares is relatively cheap, but actually equity is a very expensive source of money. Bonds, increasingly important to large engineering projects and engineering companies. And then how do you get the equipment to do these projects? Looking at things like operating leases and financing leases.
This is Christopher Simpson. I'd just like to expand a little on the slide that covered acquiring funds, just to reflect that the source of funding tends to vary somewhat between different countries, and also the perception of the level of gearing also tends to vary. And by that I mean the proportion of debt versus equity. Generally speaking, companies prefer to have a relatively high level of debt because it's usually cheaper to service debt than it is to pay dividends on an equity holding. But of course, the higher level of debt means that in uncertain times there is also a higher level of risk. So that is an important point to bear in mind.
So what areas of finance might you see within a company? What are the major financial functions you may come across? Obviously, you'll find a chief financial officer, who is really the CEO of everything financial in a company. Then you may well see a chief accountant, who looks at the accounting standards and how to report to the shareholders and the stakeholders. So really the technical specialist on accounting. You'll then see people involved in management accounting. And they're handling the day-to-day finance and accounting around the projects within that business and the various sub-organisations of that business. And then comes a very important part of the business, which would be treasury. And particularly on large projects which have a long life term, they'll be doing things like managing the buying forward of currency to smooth out cycles in currency exchange rates. They're looking for buying letters of credit, that kind of interaction, which is not what you think of when you're thinking about accountancy. Then you get into tax. And so you've got different tax regimes all around the world and different ways of things you can doing projects which are tax efficient or not tax efficient. And then finally, you'll see people concerned with financial solutions, not just for the company, but also for the customers, and looking into areas of leasing, structured finance, etc.
As far as the financial functions are concerned, Paul has referred to the main functions within an engineering company on the financial side. In my experience, it's very important to get the chemistry right between those directly responsible for finance and those with an engineering responsibility, because the two are very interdependent. Paul has made reference to treasury and buying forward of currency, which on major contracts is absolutely essential, because trying to forecast future exchange rates is very difficult, if not impossible. And the advantage of buying forward is that it means that the risk during the currency of any particular contract is then limited. Just a word about letters of credit. Be very careful about the source of these letters of credit if you're dealing with certain overseas countries. And it's very important that it's not just simply a letter of credit, but what is called a confirmed irrevocable letter of credit. Anything less than that means significant risk. And just finally, a comment on the importance of finance from an engineering or an engineer's perspective. And just simply say that it is usually much easier for an engineer to achieve competence in finance rather than financial people achieving a competence in engineering. So although there are some complexities, basically engineers have a numerate background, which means that they can usually assimilate financial knowledge with a relative degree of ease. One thing that, because of the pressures of time, we have not covered is the whole subject of capital appraisal. In other words, where a company is considering a major investment, whether it's in a machine tool or in an expansion of production facilities, the analysis, the financial analysis of a project is extremely important. And the fundamental in this is to define a forecast cash flow over the duration of the project, and then use what are called discounting methods, either net present value or internal rate of return, in order to assess the viability of the project. It's very common for companies to use payback analyses, which is a rough and ready guide. In other words, for a given amount of money invested, how many years it will take before that investment is recovered. But one of the fundamental problems is with this method that it only looks at that initial period of the payback and totally ignores any revenue generated after the end of the payback period. Now, why this is important is because very often with capital projects, one's not looking in isolation at one project, but possibly a number of competing projects. And using the payback method can result in some very erroneous decisions being made. So I would strongly recommend, when involved in any capital project, to ensure that a cash flow forecast is produced, and then that cash flow is discounted back in order to give an accurate analysis not only of that individual project, but its performance relative to other alternatives for investment.
Why financial literacy? Well, simply, it's a requirement of the specification for a chartered engineer. You have to know how to manage a budget, and if you're going to bid for and run projects, you need to understand the language of finance. So it'll limit your career if you don't have it. The other thing is, in business exchanges and conversation with people you may be working with major customers and clients, it shows a lack of business awareness and doesn't seem very professional. And to be honest, it's irritating to other business people. You know, you think about how annoying it is when somebody refers to somebody who installs a gas cooker as an engineer, and you've spent many years qualifying and achieving professional status as an engineer. It's the same thing. It's the same level of professionalism. And also, just understanding basic terms so you don't make the wrong assumption. Understanding debit, credit, income. Important things, just you know what's going on in a conversation. So in this part, I've tried to look at how finance structures affect what an engineer can achieve and what major projects we can deliver and what businesses we can deliver. What are the practical implications of how a business or a project is financed? Well, finance fundamentally shapes a business and its projects. And finance is not operating in the same game rules all around the world. If you look into the Middle East and the Islamic world, Islamic finance makes quite a difference. The cost of capital of the parties, money's cheaper in some countries and more expensive in others. A company with a good credit rating has cheaper funding available to it. A company with a bad credit rating, its cost of capital is a problem. Taxation. Does a business structure we have in the UK work in, say, America's tax structure? So that again could make fundamental changes to what we're doing. And over the years, the use of developments of financial tools and ways of financing have enabled people to afford what engineers can produce. And the example here I'll talk about in a moment is the use of a thing called an enhanced equipment trust certificate in the aerospace industry. So fundamentally, if we think about the history of engineering, would Isambard Kingdom Brunel have been renowned as he is now if banking had not transformed during his career? Particularly the repeal of the Bubble Act in around the 1820s and new acts for limited liability firms in the 1830s, and better controls of how banks issuing notes. You think about it, the Bubble Act, brought in after the South Seas bubble, was to stop people investing in things that had no value fundamentally. But the unintended part of that was people couldn't sell shares in joint stock companies. That had to be removed, so you could finance the railways, the canals, ships, bridges, etc. And Isambard's career coincided with these transformations. His father was less fortunate. Only a few years earlier, Sir Mark Isambard Kingdom Brunel actually ended up in debtor's prison, I believe. And in the end, the government saved him because he was going to go to Russia if he didn't get out of debtor's prison and get some work to do. So could the two be linked? I'd argue they are. There's a very good economist called Baumol, that's B-A-U-M-O-L, and he wrote a very good book for engineers, and he calls it the Innovation Growth Machine. And he shows how innovation in engineering and economic growth are inexorably linked. Coming into the area of Islamic finance, Islamic finance doesn't allow usury. This is where somebody just sits on a pile of money and charges people for using it. In Islamic finance, you have to participate in the venture to make money. And that creates a very different relationship between the person who is providing the capital and the person who's using it. And there could be something to learn there. And we have seen Western organizations raising money using Islamic techniques. And the airline industry, you see, which is my home territory, we've seen a growth and a renewal of the aircraft that the airlines have been using. They're using more efficient, larger aircraft, far nicer places to be as a passenger. But what they did was, and what very much enabled that, was that they took a thing called an equipment trust certificate that had been developed for financing railway rolling stock. And they turbocharged it a bit and called it the enhanced equipment trust certificate. And this lets an airline, which has a very high cost of capital, to secure funding by using a bond structure at a low cost of capital, and it's secured against the aircraft that they're buying. So instead of having to pay 9 or 10% cost of money, they can get the aircraft for 3 or 4% cost of money. So all along this, we can't get away from the fact that if we don't bring engineering talent and capital together, nothing happens if either party is missing. The next area that might seem nothing to do with engineering is accounting standards. And if you watch the financial reporting of large public companies over the last year or so, you'll have noticed large swings in their profitability and an increased focus on underlying results. This is due to two things, really. First, there's been a change to an accounting standard, which is called IFRS 15. And that changes the way in which, during a long-term project or a long-term agreement, you recognise profit. And so instead of companies being able to recognise profits early, they actually have to wait for the associated costs to have realised, and then they're allowed to recognise profit later. And this means that when this came in, companies that had been highly profitable suddenly had a bit of an issue with their profitability. And then, of course, over the next 1 or 2 years, that then backs out. And similarly, there have been changes to in financial reporting around off-balance sheet assets and liabilities. And so a document called IFRS 16 has been created, which now prevents large assets and associated liabilities being held invisible to the stakeholders as they're being held off the balance sheet. And again, this has brought in concepts like right of use assets, where suddenly, if you've got the right to use this multi-million-pound thing, it has to go into your balance sheet. And that again has caused and is causing major changes in the way that companies' profitability appear. And it's important to understand what's real and what's not real when you're looking at a set of financial data, and also looking at, when you're making decisions about a project, how it will affect a company's accounting position and its financial reports. Similarly, you can look at the effects of, I did say that treasury is very important. If you're a multinational company, you need to stabilise your currency exchange rates, you need to fix those out for a large number of years. And you'll see a company 1 year declaring record profits and another year declaring a loss, while the underlying performance is improving. And that is quite often due to the fact that they've got hedging operations on their currencies. And this is common, but is quite often misreported in the press. So that brings me to essential basics for an engineer, really. And I think those essential basics are: know how to read a set of financial statements and what questions to ask from what you've read. Know how to create a budget and understand income and expense and terms like accruals, etc. You need to realise that in a profit-making organisation, rather than a not-for-profit, the whole reason for the business being there is to generate free cash flow for the owners and other stakeholders in that business. And so when you're making a decision, or when you're thinking about a very complicated situation, I was taught a long time ago now, almost too long ago, when I was working in corporate recovery, that turnover, how big the company is in terms of turning over millions or billions, is vanity. Making a profit, that means you're just making sane decisions and you're not taking on loss-making business. But the key thing, no matter where in the world you are, is cash flow. If you're not generating free cash flow, you'll eventually run out of money and have a problem. So having taken a very, very rapid canter through the world of finance for engineering, let me come to the main part of the webinar today, which is the question and answer session on this. And I'd like to introduce or reintroduce your panel: Ishmael Erturk of Alliance Manchester Business School, Christopher Simpson of Simpson Associates, and I'll fill in some of the gaps as best I can as a fellow of the Institute of Mechanical Engineers who is currently in an extremely financial role. Thank you, and I look forward to your first questions. Hello. Well, thank you for listening to the webcast so far. So it's 20 minutes introduction, and then the main part of it is the next 40 minutes, which is for people to ask questions generally about finance and also about how to become financially literate and the key importance of it to the engineering industry. I'd like to ask my friend Ishmael Erturk from Manchester Alliance Business School if he could give about 5 minutes on what he sees as the key areas that you need to be aware of in finance for the engineering industry. Then we've got some great questions come in, which, from the look of it, we'll be having to overrun the 40 minutes maybe. So over to Ishmael for 5 minutes on key aspects of finance as an engineer really needs to know. Ishmael.
Okay, thank you, Paul. Can you hear me? Yeah. Well, I'll start with the last point you made, Paul, about cash. because people tend to confuse a profit with cash, as you have mentioned with the accounting practices. What you see on the balance sheet as profit is not necessarily the cash. So to be able to derive the cash flow from the financial statements is very important. But obviously, to understand how a business generates cash, as you have gone over the income statement, the various accounting techniques, an engineer needs to be able to understand what the financial statements tell us about companies in general, but also in internal at the internal level, the profitability of a unit or a project. So that kind of literacy is important, because making things and then convert those production engineering work into something profitable that generates cash is important. And again, a turnover, it gives you an idea about the company's performance, but if that turnover doesn't turn into a profit and then cash, that means a company is not recovering the costs. And an understanding cost is also important in an engineering context as well, because not all costs are obvious. If you're running a big organization, there are overhead costs. Their allocations are important. That's why it's important to understand the management accounting. Some variable costs are immediately visible, but in big organizations, you have overhead costs which need to be recovered, and then those need to be distributed. So that's where management accounting becomes important. But also the cost of finance is something. It can be difficult for engineering audiences because an organization, a company always needs funds from banks and from stock market, and that comes with a cost. And the lenders and providers of finance, they include a risk element, and that risk element changes from even project to project within a company. So there are less risky projects and riskier projects. So the cost of funding will reflect the risk, and then that risk it converts into the cost of borrowing money or raising finance, and that needs to be recovered as well. So your ultimate cash flow has to pay dividends and an interest, as well as meeting other costs. So that kind of framework is really necessary in today's world, where finance is increasingly important in the way even we run our daily lives. But when it comes to business, it is even more important, so that the business can survive and compete.
Mm-hmm. Ishmael, that's fantastic. We've got a lot of very good questions, and I'm trying to cluster them together to get common themes. But one of the first questions in was from Philip Nicol, which was to discuss what bonds are. Ishmael and Chris, could you pick up on what bonds are and why they're important.
Ishmael, would
Chris,
you
do you
like
wanna
to
go?
go on this one?
Yeah, okay. Now, when a company finances its operations, now obviously it's always good to use the cash. Again, cash is important. The more cash you generate, that means you can finance your expansion and then new investments by internally generated cash. And that's the major source of finance, and it is good. But it's not always enough. So a company needs to go to the bank to borrow money. Now, that money is not always for financing long-term investments. It could be meeting the cash flow because you sell things, but you don't get paid, but you have to pay your expenses now. So banks are useful to have that kind of short-term cash flow management. But when a company wants to borrow to expand, to make a big capital expenditure, then they go to the bond market. So the bond market is usually borrowing money over a year period for long-term investments. And in the bond market, the investors tend to be institutional investors rather than banks. Of course, banks can also invest in your bonds, but most of the time it will be pension funds, fund managers, and they look for long-term lending. And when you borrow in bonds for a company, there's a certainty that you have the money for, let's say, 1 year, 2 years, up to 10 years, even it could be 50 years. Very unusual, but it can go anything from 1 year to 50. So for a company, it is a better way of borrowing in longer term because you know that you have the money for longer term, but then you have to make periodic interest payments, which can be every 6 months or every year. So it is easier for the company to forecast the cash payments on a bond, and then depending on the environment. For example, at the moment, interest rates are very low. And then most companies are attracted by those low interest rates to issue bonds for longer term. But when the interest rates go up, borrowing long term by bonds can be a high cost borrowing. So bonds are a predictable form of long term borrowing to invest for expansion and then longer growth for companies. And currently, with very low interest rates, it is attractive. But obviously, when you borrow in bonds, you have to have a rating. If you have a good credit rating, that means your financial conditions are good. Again, cash is important. If you are generating profits, if you are generating cash, if you're doing profitable business, then your credit rating is good, and then you can borrow at a lower rate. So again, managing finance well, generating cash, generating profit allows you to borrow at a low rate in the bond market because you are considered to be less risky.
Okay, that's super, Ishmael. We've got a grouping of questions here, which from some of the younger engineers online, which are really best, which I'll summarise and I'll put them together. Is they're not involved in finance yet, but they want to know how to learn to read a set of annual reports and pick up financial awareness. And it's really what's the best way to start and where to turn to. So, Chris, would you like to go first with that one, and then Ishmael?
Yes.
Yep.
Hello, everyone. it's a fundamental question that faces so many engineers, young engineers, when they're in the transition period between a purely technical role and a management role where knowledge of finance becomes ever important. I'm going to start by making a plug for the IMechE in that they run excellent financial courses, and I would suggest if you go on the IMechE website, you'll see details regarding that. If it's at all possible, I would recommend doing an MBA. This is something that I did, and I found that it was an investment for the rest of one's life. And of course, MBAs the courses tend to focus strongly on finance. But if that's not possible, then just do as much background reading as you possibly can. There are plenty of good textbooks available, which we could recommend. And if you have an opportunity to talk to your colleagues in finance, well, get their advice as well. But it's important, and I wish you well with it.
And Ishmael, well, I'll point out he's from Alliance Manchester Business School, so and I know Ishmael I did my MBA there. Over to you, Ishmael.
Right. I mean, just to add to what Christopher said, yeah, I mean, doing an MBA is very useful, but if you don't have time or for whatever reason, I mean, reading a book, there are various textbooks, but the ones that are written specifically for non-financial managers is the one that you should start with. So there are books called Finance for Non-Financial Managers. So those are the types of books that you should be looking at. But also, I would recommend to read Financial Times on a daily basis, especially the companies section. I mean, you can subscribe, and if you subscribe, obviously there are links now. I mean, internet is a wonderful invention. So if you have a digital subscription to Financial Times, they have links that explain the words and then the concepts. So I recommend to read the company's pages of Financial Times. But with a book, there's also, I mean, they have to read the Financial Times kind of good books as well. So those are the things that I would recommend.
Yeah, and Paul here, just one thing I'd throw in. I picked up a book which I found, over the years I found invaluable, and it was by Wiley Science, which was Crash Course in Accounting and Financial Statement Analysis. And I think it was the first edition. It's probably on edition 10 now. But it's not a thick book, and it's got worked examples, and a numerate engineer should be able to go through it in a weekend, and actually you begin to understand, or it begins to unlock the secrets. So that would be mine. Have a look for Accounting and Financial Statement Analysis. I found it helpful, but I'm sure it's on issue 10 by now. We're getting quite a few technical questions coming in. There's a short, quick question for Chris, which is, what are letters of credit? And that's from William Madavalan. Apologies for the pronunciation of your name, William. So, Chris, letters of credit.
Yes. Letters of credit are mainly relevant in the context of overseas trade, and particularly with developing countries where there's a possibility that a particular customer may not have the financial stability to give one total confidence. And in these circumstances, part of the contract will be to ask the customer to instruct his or her bank to issue what is called a letter of credit. So this means that effectively you have a bank guarantee regarding payment of the particular product that you are exporting. It's a complex subject, but that essentially is the fundamental background and reason for asking for letters of credit, to give one greater confidence that you will ultimately get paid.
Okay, super. We've then got, I think it shows a theme for another webinar or even a short course at the IMechE. There's a lot of interest in how to evaluate capital investments and business opportunities. And I guess the first thing is an overview of the different methods we could use. And then there's quite a bit of interest in discounted methods, which I think we both mentioned, Chris, and
yes.
using them internally and externally. So I think we'll all three have to have a go at this. I mean, from my working experience, I view payback periods as being something you really shouldn't go near. You just make the wrong decisions.
Exactly.
That's my prejudice.
But a correct prejudice.
And then mostly the other ones have been built around where it's a fairly steady, certain industry and there aren't major disruptions and there aren't major innovations coming along, then using discounted cash flow methods, which I'll lean on Chris and Ishmael to fill those in a bit. And where things are very uncertain and you're pioneering, you're breaking new territory, then the use of more economic methods of evaluating business and its risk. I've used things like real option analysis. So I think over to Ishmael first and then Chris on sort of preferred ways of evaluating business and capital investments.
Right. Yes, I mean, discounted cash flow is extremely important in the sense that, again, when you look at any project, I mean, it has to create a value, and the value creation can be measured through the cash a business generates. Because when you are discounting the cash flows rather than accounting profits, you are really looking at, how much cash. I mean, if you're an individual, it is your bank account, which is accessible to you. So for companies as well, you need to recover all your costs, and then sometimes those costs are not as obvious. For example, there's something called net working capital. Like if you are producing but not selling, and what you produce stay as a stock, that means it is consuming cash. So it's only when you sell it and recover the cost. Or if you are selling products, but if you're not getting paid because you have long credit terms, it's not generating cash. So discounted cash flow takes into consideration not just the obvious immediate costs like labor, material, but it also takes into consideration the cost of keeping stock, a cost of selling with credit, but also a cost of, because when you discount, the discount rate reflects the cost of borrowing money. So you need to meet your shareholders' expectations in terms of dividends, and you need to pay your bank and other providers of finance. So discounted cash flow methodology is really the best method. It has its own issues, but I mean, those can be covered in a more sort of advanced module, but as Paul said, not all businesses are not obvious in the way they create cash flows. Sometimes, because especially if you're doing things that are technology related, or because you don't know how technology will evolve in 5 years' time, then options introduce that possibility of creating cash flow because of changes in technology in the future. That's basically, I mean, looking at a scenario analysis, and then looking at the probabilities of which of those scenarios is more likely to happen, and then use the valuation. But it is again discounted cash flow methodology, but for more uncertain future, because the product or the project is more technologically sort of complex. So those are more useful for those more advanced and then technologically heavy projects.
Okay, and
right. If I may, this is Christopher now, if I could come in. It may be that some of our listeners are not familiar with this phrase of discount rates, discounted cash flows, etc. But fundamentally, it's based on the theory that if somebody offers you £1 now, you would value that at £1. But if they say, yes, you can have the pound, but you get it next year, then you're not likely to be willing to pay now £1. So that is the concept of discounting. So as Ismail has described, where you're looking at an investment project or comparing alternative investment projects, the fundamental is first to produce a cash flow year by year or month by month, and then discount that. So that means that a project that produces a strong cash flow in the earlier years will have a higher value than an alternative project that produces more cash in the later years, because that ultimately has less value to the company. Now, some of you may well ask, well, how do you actually fix the discount rate? Well, we would need a day and a half at least to cover that. But fundamentally, the discount rate is the cost of capital to the company. And usually, you would make an adjustment on that to cover the relative level of risk attached to any particular project. So I hope that's of a little assistance. In terms of the main alternatives of what's called net present value, so in other words, you discount that future cash flow back to a current value, or a version of that is what's called the internal rate of return. In other words, the rate of return that particular stream of cash will generate. Now, just a word picking up on Paul's correct disparaging comments regarding break-even. The problem with break-even is that it only looks at a project for the period of time until the break-even point, i.e. the money invested is returned. But many projects will have a long-term cash flow which the break-even analysis completely ignores. So reliance simply on a break-even analysis can cause one to come to some very wrong conclusions about the value of a project, or even more importantly, the value of one project compared with an alternative project.
Well, thank you, Chris and Ismail. I think the important thing on this is picking the appropriate method for the business situation you're in. The question on how do you work out a discounting rate to use, quite often I look at how our potential customer might be seeing their cost of money, as I would call it. and so I'll go and have a look at what their WACC is, which is a lovely thing called the weighted average cost of capital. Now, it's not going to be accurate as to what they're actually using as their discount rate, but it's usually good enough to give you a feel for how their discount rate is going to compare to our discount rate. And then that's very, very important for what decisions you make about whether your preference is for cash up front, cash later, cost up front, or cost later. Because obviously the opposite part of the cash is the cost. So you really have to look at what scenario you're in and be aware of what your partners are looking at and what their costs of money are. The actual discount method to get to an MPV is, for an engineer, a very simple calculation. And I do think we ought to run a session on this, Chris, to be honest.
Yes, I'd be very happy to do that if there's interest, because it is fundamental to, I believe, any engineer's financial knowledge to feel comfortable and confident about undertaking that sort of analysis.
Now, if I can move on to another area that, again, there seems to be a few questions that are similar. Michael Parton has asked a question about structured finance and what's the difference to leasing. And I think this will let us talk about quite a few different things about how projects and major engineering activities are financed. And we are intending to run a webinar on this later in the year around project finance. So if Ishmael would like to go first on structured finance and leasing, and then Chris, and then I'll try and appear intelligent on the subject in third place. So over to you, Ishmael, for Michael Parton's question.
Right. Okay. Yeah. I mean, the way finance projects or activities can take various forms, and because the projects differ, financing methods will differ as well. Now, I think leasing is now becoming more common, because in the UK, people used to borrow money either from the car company or from a bank to buy a car, but increasingly with the hire purchase, it is a form of leasing. So leasing is basically, I mean, it can take various forms. You don't, I mean, basically you don't own in general the equipment forever. You rent it and then pay the financing costs during the period. So it is useful in areas where the technology changes. So it is the option to not to own, but basically pay for rent. Paul mentioned Islamic finance. For example, in the Islamic world, they do leasing because the finance company buys the equipment or the machine or whatever the customer needs, and then rents it. But for accounting purposes, it can make a big difference for companies, because one of the costs is something called depreciation, and it can change your reported profits. So leasing is also a useful tool in the way you use depreciation, which is a complex topic, but it is how you can influence your reported profit, because then you don't charge the capital cost of using the equipment. Now, structured finance, it can take various forms. It can be securitization. I'll very briefly talk about securitization, which is basically borrowing against the future revenues of an asset a company has. Now, one of the assets, obviously, we have physical assets, but also you have monetary assets. For example, a company sells products on credit, and then for some companies that can be a substantial part. So what you sell on credit, you don't get the cash now. So what you do then, you take those receivables, which they appear as receivables on your balance sheet, to a bank or a financial institution, and the financial institution pays you cash now, and then owns your receivables. I mean, it can be in the form of factoring or forfeiting, especially in exporting business. Is being used as the simplest form of structured finance, but it can be more complicated. But it's in the simplest form. You sell your receivables, you securitize your receivables, you get the cash, but you pay a cost for getting the money now in the form of a discount. And depending on the complexity of the company, for example, it's a project. If it is a big project, structured finance can mean a share in the risk from between the manufacturer, the buyer, and other stakeholders like financiers. So it can involve financing a particular big project where the financing need is big, by raising some equity, borrowing from the bond market, and using other short-term methods of financing as well. But that would apply to big projects where the financing need is huge. And it's also sometimes useful to structured finance, because then what you can do is you can create a new company or SPV that takes the risk off the company's balance sheet. So you have a separate company specifically set up to finance that big project, which means then the lenders, the financiers, look at the risk of that particular project rather than the risk of the big company who's involved in that project. So that can be useful in terms of reducing the cost of financing. So that would be more advanced form of structured finance.
That sounds great, Ismail. And before we go to Chris, a couple of things I'd like to raise there is the special purpose vehicles or special purpose entities. They work in both directions. They can be to immunize the company that's running the project from the risk of business failure of the project. Also, quite commonly now, they're used to basically form a company that owns the big asset, that has a long-time economic value, and eventually enables people to borrow against that asset at a low value at a low cost, because that special purpose entity or vehicle is almost immune to business failure, whereas the people using that asset might go bankrupt. So it can manage risk in both directions. And I think the other one that's interesting is Jim Ratcliffe, who came to talk to Manchester Business School about setting up INEOS, who's now Britain's richest man. I believe he said that they typically had, when they were buying something new or financing a new operation, he had somewhere like 200 banks taking part in those transactions. So Ishmael's point is, this is complicated. That's how complicated it can be. But over to Chris now. Any other views, Chris?
Yes, I rather think there may be a few glazed eyes at this stage for the listeners of the complexity. I'd just simply like to say that, generally speaking, the more complex a financial structure, the greater the risk for somebody. The other factor that hasn't been mentioned is that taxation can have a significant impact on the particular type of financing that one is looking at and ultimately decides upon. If I may, Paul, there was a question about gearing and risk, and what we've heard is relevant, I believe, to this, that essentially, if you borrow money, you have to pay interest and you have to pay it back. So, simply speaking, if in your balance sheet you have a high level of debt, then that means in a period of recession or business downturn, the risk profile is commensurately greater. So the more secure businesses are the ones that operate with a significant proportion of their own equity, either in terms of capital that is paid by the shareholders, or reserves that are built up over years. So when you're looking at the relative security of a particular company, then gearing is of very real significance. And the temptation for companies to gear highly is because, generally speaking, it costs less to service debt than it does to pay dividends on equity. The reason being that if a bank lends money, then they will usually have a claim on the assets, and they would regard the money that they've lent as relatively secure. If you're a shareholder in a company, you are well down the queue, even almost at the bottom of the queue. If things go badly, you're the last to get your share of the money back. So for that reason, equity tends to demand a higher rate of return to cover the relatively higher risk factor. So I hope that's of some help.
I think it will be, Chris. I'm mindful of the time that people will start having to drift away because we're about to overshoot in fact, I think we have just overshot our allocated time a bit to a degree. The last point that Chris was raising there, again, this Jim Ratcliffe who set up INEOS, he basically doesn't let anybody have equity in INEOS except him and his family, and it's all financed by debt, which is an interesting stance. I've not seen that before in a company that size. I'd like to thank Ishmael and Chris for helping me with this. I think there were some people who were hard hearing things at the beginning, but there is a recording going to be available of the webinar, and there's an enormous amount of questions that we've not been able to answer. I've tried to package as many of them as we can, and I think what we'll do is, certainly I'm open to being contacted via the IMechE or via my office email, but preferably via the IMechE. And I think one of the big things here is, what are the next steps that you might want to do to advance your financial learning? And also, if any of these questions are still burning questions, certainly contact me via the IMechE. Does that go for you as well, Chris?
Yes, absolutely. I spend quite a lot of time abroad on business, but for that reason, if it comes through the IMechE, I'd be very happy to respond as far as possible.
And the other thing being, I'd really like to thank Ishmael Erturk from Alliance Manchester Business School for his input. He's very much seen as an expert in this area of what engineers need to know and finance for the real world. So I'd like to say thank you very much for taking part, Ishmael. And,
well, great pleasure, Paul.
Yeah. And certainly you did a reasonable job of educating me.
Right, so I'm glad something worked. But yes, I mean, finance is increasingly getting more important, and it is a big topic, but I think this was a very good first start. But once you build the building blocks, I think Chris was referring to that as well. It may sound complex, but at the end, once you get the logic, I think this first webinar allows you to get that first building blocks. Then it doesn't become complex because you know what the fundamental principles are.
Okay, that's superb. Right, so I'm going to draw things to a close now. What I'd like to say is probably the best. Trying to think on my feet about this actually, because I'm surprised by the number of questions we've got. Where we haven't got round to your question, we have got a LinkedIn group for the management group of the IMechE. So I'd encourage you to look that out. And also watch for further communications, because obviously we've got to do something to tie up the questions that we've had here. Because I think it shows a real burning interest in this area. And I would really like to thank everybody who's phoned in today and connected online. Particularly like to thank those people who've asked some great questions, and also those people in the future who listen to the recordings. So thank you on behalf of myself, the IMechE, Ishmael and Chris.
Thank you, and I wish you all well.
Yes, same from me as well. All the best.